Here, let's get the invite out. If you are joining on the replay or the podcast. Uh-oh. Cash tags. Too many cash tags. We got to get rid of some cash tags. What cash tags we got? Oh, I mean, we got multiple cash tags here. Good Lord, you guys, man, this Twitter is limiting my cash tags, so we're gonna cut down on some cash tags here. Let's get rid of some cash tags, and then we'll be better off. Hopefully that's enough. Good Lord. Come on, guys. I pay for this service. Let me have as many cash tags as I want. All right. The Twitter invite is out. Veterans, please share and retweet the invite. For the rest of you on the replay, you can fast forward to the good stuff. We're just waiting for the live studio audience to come in. Those on the podcast, same deal. By the way, those who didn't know, this is now a podcast available for you on Apple and Spotify after the show. Okay, so good news there. For the rest of y'all, welcome. I am Money Mark, the 30-year veteran of Wall Street technology. Retired in 2008, a multimillionaire at the ripe old age of 38. And since that time, what has it been? 18 years. Providing my picks for free to the rest of y'all as my give back to society. Why? Because my mentor made me what I am. Not the, happy birthday, by the way, mentor. Not the stock market loser that I was coming out of college. Why? Because college is a ripoff. CNBC is a ripoff. My mentor taught me the real deal, changed everything. First 3 years of investing, lose. I was down all 3 years. Since then, I've only been down 3 times since. 27 out of 30 years, up. All right, and having another great year, up over 100% year to date. And we're going to bring to you everything that goes into that. We got earnings reports. We got the AI update. We got top picks in my portfolio. So we got a lot going on. I am not going to wait much longer for the live studio audience. In fact, let's get right into the macro, and everybody else can join as we come along. But just make sure you veterans are sharing the live, because you know what it is. #team. Let's see, make sure we got, we got audio. Okay, cool. We got over up. All right, beautiful. We got everything we need right now. Let's just pull it. Look at that, just to make it official. There it is. All right. We got a live studio audience. We got lots to talk about. We got Friday. We got Money Mark. We got Stock Talk Live. It's a big show. Here is the disclaimers on your screen right now. Suffice it to say, if you are watching this show, and it's also in the description of the show if you're on the podcast and can't see the screen because you don't have a screen, check out the description and just know that there is a disclaimer here. And if you continue forward watching this show, that you acknowledge and accept the terms of this disclaimer. I am not a registered financial advisor. I am not your registered financial advisor. And all of this is for informational, let's call it educational and amusement purposes. All right, get that out of the way. Next, let us get on with the stuff. Once again, I'm not going to have time to get into all the details of who I am, what I do, but suffice it to say, in past episodes, go back like 2 or 3 episodes and you'll see me open this show with a whole description of why there are 10,000 clowns out there and how to tell the difference between them and the real deal. All right, I'm not telling you I'm the real deal. I'm not telling you I'm the only real deal. But the fact of the matter is, if you don't have somebody giving you their real name, their real credentials, and a real-time tracker of their performance, what are we doing? What are we doing? I mean, where are your credentials? What makes you a professional, an expert? Me? I served Wall Street for decades. Jim Cramer's funds, George Soros's funds, and if you saw the movie Dumb Money, Stevie Cohen's funds paid me for my research, paid me for my stock picks. Okay? Those are my credentials, in addition to my industry credentials. We're not going to get much more into it, but it's all up here. Maybe we'll have time to talk about it next week. Here is my real-time performance tracker. It is doing pretty good, I should say. Look at that. Okay? That's out there on the internet for you guys to check out. It's in the description, the link to this. So let's keep moving. By the way, if you are new, you need to listen to this. Finding multi-baggers like Money Mark on my Twitter stream. Read Get Rich on Stocks, the rules in my what do you call this? My website. Let's call it a website. markohmstocks.wordpress.com, and watch this video on my YouTube channel. It's not pinned up here, but it is same thing, making money on stocks, basically. That'll help you understand everything I'm talking about here, because I don't talk the same way as everybody else out there. Those 10,000 clowns. We got red lines, we got green lines, we got white lines, we got gray lines. And the veterans understand what that all means, so I'm not going to go over that. If you can't educate yourself, then you can't make millions, period. And the veterans can justify that, verify that in the chat. And speaking of the chat, don't pimp your own names. Don't troll me in the chat. We have moderators now that will ban you from the chat. You will never be able to say anything in the chat again. You'll have my sympathy, because trolls are just people that didn't get love from mommy and daddy, and that's sad, because then that makes them into people that only get happiness from making other people upset, and I feel bad for you. So that's it. This is my show, not your show. Do not put your picks in the chat. But this is your show in terms of Q&A. So if you have any questions, put them in the chat. Question mark, question mark, question mark at the beginning of your question so I can see it, because we get a lot of comments in the chat and we're going to have a lot to talk about. Let's get into it right now. The macro, we're going to go real quick. We are in greed territory ever since we bottomed out with the 25 fear reading, which I don't love. I like to see fear get down to 10. It didn't. Things are a little too strong out there, right? The economy's strong, the earning. Dude, Q2? I mean, S&P 500 revenue growing double digits in an economy that only grows low single digits? Come on. It's an incredible environment for stocks, and that should continue, but we are at elevated levels. You will see when we go to the chart soon. The 2-year yield still looks like, we've been trending down for a few weeks. All else being equal, positive for stocks. Not much else to say, okay? Oil prices, boom, not threatening. Everything's nice. The macro is playing nice with us. I've written some articles on my blog site. That's what it is, a blog site, markohmstocks.wordpress.com, about the macro, so you can understand what's going on from a liquidity standpoint. By the way, nothing I do has subscriptions, advertisements, sponsorships, nothing. I make no money. No way. This is a complete donation of my time, because my mentor gave me a donation of his time. So there's no tricks. There's no nothing about this. None like the 10,000 clowns that are trying to get your eyeballs and sell you something, often their picks. I don't have 300,000 followers because I'm not spending time trying to get 300,000 followers. It's not that hard. Just spend a little money. But you know what I do have? 60 subs away on this YouTube channel from 6,000. So get in there, hit the subscribe button. I never ask for that, but since we're only 60 away, hit the subscribe button, and definitely the thumbs up if you like that somebody that serviced Wall Street, the fat cats, making millions per year, retired and started doing this for y'all, the mom and pops of the world, for free every week. All right, let's get into the real meat. What you're really here for, AI. Jensen Huang says Wall Street's independent underwriting breaks the circular loop, but Nvidia may still backstop as much as $125 billion. I've been telling the dummies, Michael Burry, stupid dummy, you idiot, making all those monstrous bets against AI. Dude, all you have to do is watch the show and you would know, like everybody else, AI is not a bubble. Okay? Yeah, we are in a CapEx cycle, an up cycle, and yes, that will subside at some point. I don't consider that a bubble. I call that a build-out. You veterans out there already know that's what I've called it. It's a build-out, not a bubble. There's a difference. The internet was a bubble. Let's bring up the chart. There's your QQQ chart going back to the 1999 era, and you can see the big bubble that formed. Now, Just to put it in perspective, I've got a Dow Jones chart going back to 1915, not 2015, 1915, and there it is. And you can see the 1929 bubble right here on the screen. Okay, the one time in Dow Jones history that the market popped above this red line. Except now, we're getting a little pop. Okay, but then the Qs, look how much that popped above the red line during the internet bubble. That's a bubble, ladies and gentlemen. Look at this little circle right here. That's not a bubble. That's a blip. Can it turn into a bubble? Yes, there is a good chance it can. And that's why you want to be involved with these AI stocks, especially the best ones at the best times. We are going to go over many of those names, including the ones that are largest in my portfolio. My new pick that is related to AI, my existing picks, a lot of earnings reports. We got it all here this week on Stock Talk Live. Let's keep going. By the way, this right here tells you, this Jensen Huang article, what I've been telling you. Who cares about this circular financing? Listen, if you were Jensen Huang and you had billions of dollars to throw at companies that are emerging as the leaders of the AI revolution and help them become successful, would you not? Are you crazy? That's not circular financing. That's investing. Okay? And yes, you can call it circular financing because it does make a circle. Congratulations. I never noticed that. I never noticed that in my 30 years in technology. I've never seen that before. I've seen this the whole time. And yes, circular financing can be problematic. But these idiots out there that are not technology experts, much less AI experts, are out there trying to tell you that there's a problem with this. No, there's no problem with this. And in fact, Wall Street's jumping in. All right? Wall Street's jumping in. They're getting more excited about financing this stuff because what they're finding is what I told you when Michael Burry said, the depreciation of AI. Shut up, stupid. Dummy. But by the way, people that idolize Michael Burry because of The Big Short, name one thing he's gotten right since then. Okay? I'm waiting. Even a broken clock tells the right time twice a day. This idiot talk about depreciation of AI data. Stupid. We're not seeing that, are we? In fact, the rent being charged by AI data centers now has doubled since he said that. Well, that doesn't seem like a depreciating asset to me, does it, stupid? It sounds like an appreciating asset. And I didn't expect that, but I didn't expect it to depreciate at the rate that he said either. That was dumb. Right now, we are getting an appreciation of these assets because there's not enough components out there. There's not enough AI data center compute capability out there to meet all the demand, Michael Burry. Because the use cases keep expanding in a way that your little brain can't imagine. And in a way that my big brain can't imagine either. Because it's not my job to spend 100 hours a week figuring out what to do with AI next. That job belongs to the CEO of OpenAI and the CEO of Anthropic, of which you are neither, Michael Burry. So, I'm going to feel bad when they bury you for this stupidity. It's dumb. You guys need to realize, if anybody tells you that AI is false, a bubble, you name it, it's wrong. At some point, there will be a bump in the road. That's a bump in the road. That's different. Every company has a bump in the road. I showed you the example last week. There's Salesforce.com. Each one of those circles represents a time when the stock dropped 30% or more. And in every single case, there should be one more circle right here because it happened again here. Okay? And you see the stock rebounding off of that white line level. Every single time the stock went on to make all-time highs. Will it this time? I don't know. But look at the 1, 2, 3, 4, 5, 6, 7, 8, 9 times. 9 out of 9 times. If it doesn't happen this time, it's still a 90% rate. That's Larry Bird's free throw percentage. That's Steph Curry's free throw percentage. These are free throws. Okay? Every company goes through bumps in the road. AI will be no exception. But this is not a bubble. This is real. And Wall Street wants in now because they're seeing the value. Okay? Wall Street doesn't put their own money on the line for any other reason. Come on, man. You let these dummies know what's up. And here you go. Server DDR5 memory rises another 15 to 23% across the board this month, on top of what we've already seen. Okay? Look at what's happening. This has actually become a problem. We saw it with one of my favorite, in fact, let me look at my portfolio. This is now one of my top 3 holdings, RDCM Radcom, a huge AI beneficiary that we're going to talk about today. But they missed their quarter. And why? Bad execution? No. Bad demand? No. AI is pushing demand. They couldn't get enough memory into the ecosystem. Radcom sells software into companies like AT&T. AT&T uses that software in conjunction with network equipment by Ericsson. Ericsson couldn't get enough memory at the right prices. We're going to get into that in a little bit. But this is affecting anybody that needs components around the world, including Apple Computer. So if Apple is getting hurt by this, so is everybody else. But guess what? Apple is an AI beneficiary. You should own the stock. Radcom is an AI beneficiary. You should own the stock. All these companies and any company that gets hit with these component shortages, you should own the stock. Because AI is going to be a tailwind for them. You don't know when the component's already, like, as I'm going to tell you with RDCM, that component problem is not much of a problem going forward, and I'll explain to you why. And as that abates for other companies, they're going to take off. And it's going to fix for those companies before you know it. And it's going to fix for those companies, right? When it does, Wall Street's going to be the first to know, not you. You're going to be the last to know. And by the time you find out, the fat cats will have already owned these stocks. So stop thinking about, am I going to make money today? Am I going to make money next week? Shut up, stupid. Warren Buffett didn't become the richest man on earth with that attitude. Okay? Get that attitude out of your head and maybe you'll start making some real money like your buddy Money Mark here. Boom. Speaking of AI, wow, air just keeps on rolling. AEHR, my bad, y'all. I mean, yeah, I can pat myself on the back for giving you this stock under $3 per share. But I also said no mas around 76. 76? Oh, let's go to the charts so we can, oh my. 132. This stock just does not stop. Okay? I'm not owning it. It's over the red line. I can't figure out what Jeffries was talking about. I'm going to read the Jeffries report soon because Jeffries just upgraded the stock to like $175 price target. Be careful, y'all, because in the internet bubble, I remember analysts playing this game of trying to one-up each other in terms of price targets and trying to justify it with price to sales ratios and stuff like that. That is not how you value a company. That's how Wall Street gets people to buy the stock, because that's how Wall Street makes money. Brokerage fees and the like. Okay? So stay tuned there. Let's make no mistake, though. Me getting out around 76 wasn't because I was bearish on the company. I love the company. I'm bullish on the company. I am bullish on AEHR. And when it dipped back below 76, you saw we had another chance to get in at 65, and I did. And hopefully you did too. And then I got out again, and it just keeps going higher and higher. I mean, I don't know what to tell you. Okay? And yeah, if you own it and you're like, this is a monster, Mark, you're so dumb. Fine. Fine. Okay? Like, I'm not playing that game. I'm just playing with these lines because my way works. There's a really good chance that anybody that goes, oh, Mark, doesn't have as much money as me, so, oh, stupid. I ain't playing it. This method works. In a bubble, it'll work a little less because bubble names will bubble. That's probably what the channel looks like right now, by the way. I'm adjusting it. This is just, these are technical lines, right? Gray lines are always technical. And that's what's going to happen. You're going to see companies become bubblicious in a bubble. A stock market bubble. AI is not a bubble. But the valuations out there are getting bubblicious. I told you that a few months ago, and you've seen these stocks bounce up and down around the red line level, right? We saw that with NVIDIA. Boom, look at that. This red line has been there for years. I gave you this line when I gave you this stock at 42. It's now 225. And every time it got to the red line, I told you, I don't know. It's best to not be in it. And that has worked really well. And look at this red line. This red line that's been there for years is serving as a gravitational pull on the stock. Why? It's not a surprise because I did my work on this. Wall Street did their work on this. They don't make risk reward lines. I make risk reward lines. But if you do the same work Wall Street does and we come to the same conclusion, what'll happen is the stock will tend to gravitate to a line like this. It just so happens that I'm the only person that delivers lines like this. Okay? These are fundamentally based risk reward lines. They have nothing to do with technicals, as you can see. These lines don't seem to, the red and green lines seem to make no sense to any of you. That's the right way it should be. Okay, because they're based on fundamentals and they are the cheat code to how I make money. I buy low in the range and I sell high in the range. Now, that being said, okay, this is important to talk about. Part of the way I make millions, we talked about this a little bit last week, is by owning different types of stocks. Okay, one type, obviously, we're talking about right now. Hot stocks in hot areas at a good price. Right? And risk reward at a time like this doesn't matter as much for some of these names. Now look, NVIDIA is not one of my top holdings, but I own a good amount of NVIDIA at this moment because of two things. Three things actually. One, the valuation is fair. They're operating on all cylinders. So the red line valuation is fair for what the company's doing. The red line represents on 10 valuation. Well, the company's on 10. So this valuation is justified and the company continues to grow, right? With a CAGR of 20%. So all else being equal, I should make 20% on this stock as my 50-50 bet anyways. But if it goes into bubble territory, well, shoot, 300 is 33% up from here. So I've got optionality on making more money on this stock, right? But those two things notwithstanding, I want to make sure that the third thing is in place, which is my industry contacts confirming momentum in the business beyond what everybody else might think. And that's what I'm catching wind of because our good friends at TSMC, maybe type it in properly. There it is. Another stock I own, this is one of my top 5 AI holdings, okay? I've got 3 types of holdings. AI, right? NVIDIA, Marvell, TSM, KLA. Those are names we'll talk about more, right? And I've got one bucket where I keep those names. In the other bucket, a much larger bucket, is where I keep the names like you see in the spreadsheet, okay? And this breaks down into 2 categories. The stocks that are too cheap, but not necessarily executing right now, they're either in wait time or going through a rough patch, but they're too cheap to not own. And when that happens, one of 2 things happens. One of 3 things. Activists can come in and change things. TPCS, boom. If you bought at the green line level, look what's going on. We're going to talk about this. This stock is still too cheap. But if you bought it at the green line level of $3, you're almost up 100%. If you bought more as it dropped further, when I did my clear out trade down here at about 250, you're up more than 2x right now. When nobody else wanted to touch this stock, I was telling you it's too cheap. Yes, it's in a rough patch, but these things get repaired. One of three ways. The rough patch ends naturally because management works their way through it. Activists get involved and force the issue on management, which happened to be the case here. Or number three, they get acquired by somebody that can do that job. Okay? The reason this green line is there because your friend, Money Mark, 30 years experience doing this, 30. Good Lord. I actually started getting involved in stocks around 1986. So it's been 40 years. But real experience is like 32, 33, whatever, right? Learn how to draw these lines. Learn how to find out what is the absolute minimum a stock should be worth even going through a rough patch. And when we get down to those levels, I want to own those stocks because I know that one of those three things are going to take it back up, okay? So, back to the spreadsheet. I own a lot of these stocks. I own a lot of shares of these stocks. Most of my money is in stocks like these. One category are the cheap names I just talked about. The other category are the names in here that are rocking and rolling. Okay? Like Gatekeeper, like Crescendo, despite what the stock is doing, like TPCS, which is rolling. So they've graduated from the category of too cheap to not own to rocking and rolling, okay? And I'm going to give you a little cheat code. For those of you who keep your notebook out, and I've told you a million times, I haven't said it in weeks, but the best investment you can have is a notebook and a pen because the brain is a processor, not a hard drive. If you've ever forgotten something, it's not your fault. It's because the brain is a processor, not a hard drive. So you need an external storage device, like a notebook. And in your notebook, what you should put is this. Everything I just said, but on top of it, the juiciest of the juicy stocks in my spreadsheet are those that are trading for the lowest price in the risk-reward range relative to how many cylinders they're operating on a scale of 1 to 10. Okay, TPCS is no longer operating on just one cylinder. The stock at the green line, when they got down to the green line, it was deserved because they were operating on one cylinder. But my assumption was someday they will be operating on more cylinders, and therefore the stock will move off of the green line one cylinder level and closer towards the 10-cylinder red line level. How many cylinders are they on? I'm not going to disclose that every week. I'm not going to go through all my names. I'm not going to answer that question. So don't ask me. But sometimes I will give you a sense when it's at an important juncture. And at this juncture, TPCS, bro, I got to say, they're operating on more than 5 cylinders now. They're heading towards 10. I feel like this company is heading towards and will. If you don't believe me, go listen to their last 2 earnings calls. And you will probably agree with me. This is a company heading towards 10 cylinders. And you see what the 10-cylinder price is here? $15. This stock does not belong at 6. Okay? You see the 5-cylinder line way up here at 8. And I think they're operating on more than 5 cylinders right now. We'll get back to that in a second. But that's what you want. You want a company that is selling, right? They're at about a 3 in the risk-reward lines. You can see there's the green line is a 1. The red line is a 10. They're at about a 3 on a scale of 1 to 10. But they're operating on something more than 5, maybe 6. That's a gap. That's a big gap. 2, 3 points is a big gap. You can get bigger gaps. But that's a pretty big gap. That's juicy. That's yum, 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 yum. Right? Gatekeeper. They're operating on 10 cylinders. Okay? And I told you they were going to be operating on 10 cylinders when they were selling for 5-cylinder prices. And now they're selling for, what, 6 or 7-cylinder prices. But that's still a 3-point gap to the 10. These are names that you want to own. The stock is undervalued relative to the momentum that they have, the number of cylinders that they're operating on. Hopefully that makes sense. If not, go repeat it later on this broadcast. Go watch the replay, etc., etc. It's very important. This is how I make the most money. This is how I make the most money. Buying stocks when they're too cheap, when everybody's afraid to, and buying stocks that are doing great but are not fully reflected in the stock price because they're operating on more cylinders than the risk-reward chart implies. Okay, so Air, off the charts, they're doing great, no problem. I can't. The valuation is hard to justify. I've known the CEO for over 10 years. Okay, me and Gain, I got his cell phone number, he's got mine. We're buddy. Okay, and we talked about this. I said, Gain, for every extra 100 million, the next 100 million in revenue you make, what is going to be the impact on your EPS? And he said, $1 of EPS. It's actually a very easy rule of thumb, Mark. I didn't make this up. We ran the numbers, and it just so happened to work out that way. The next 100 million of revenue will drop about $1 of EPS to the bottom line. Okay, cool. Now I know what to deal with. And what's funny is, if you look at these Wall Street expectations, right? What do you see here? Let me get rid of this. It always does this. That's fine. All right. This highlighted yellow line right here. Look how it goes from $1.38 in fiscal 28 to $2.28 in fiscal 29. That's almost $1. It's about 90 cents. Well, look what it takes in the revenue model to make that happen. 70 million of revenue. 70 million of revenue should be about 70 cents. That's in the ballpark. Wall Street gets it. Okay? So this is working. But here's the problem. We're looking at their 2029 numbers. It's 2026. We're looking at the 2029 numbers. And the 2029 numbers call for $2.27. Now, they're going to beat that number. That's my belief. I really believe they're going to beat that number. But let's do some math here. At $132, if they get a 20 PE, a couple years from now, right, they have to deliver $6 of EPS, 6.5 to be precise, to justify this valuation. To justify this valuation in the future, not even today, right? And for them to do $6.5 of EPS, they're going to need about 700 million of revenue. We're not close to that. I don't know how they get to 700 million in revenue. If you can tell me, then I'll say, okay, cool. The stock's Gucci at this price. But otherwise, it's too dicey for me. There's the lower hanging fruit. I'd rather own Nvidia. I'd rather own Marvell. I'd rather own TSMC, right? Micron. I own Micron. I own Iron. There's a lot of names you can own and make money. It's cool that I love it. I love that Air became the darling that it did, because I was here telling you to buy at like $2.70 years ago. There you go. Buy gold mine right there. Right? You can go back to the old videos and whatnot. That was a thing. So I love it that we've gone from 2 to 132. It's nothing new, right? That happens in my career. But there's a limit. All right, let's keep going. I don't want to belabor the point, but I wanted to teach you guys something about valuation here. This is crazy. So speaking of AI component shortages, right? I'm here giving you information that you don't get from anywhere else, right? I get the kind of information that Wall Street used to pay me for, except I give it for free. I have contacts all over the world, people that get me information from Asia, things like that. And this is how we do things around here. This is how we make money around here. This is how I help you make money. This is how SMCI, I told you to short it like 72. That worked out well, right? It still hasn't gotten back to 72. It got into the 20s, I believe. 17. It got under 20. That was a great short, because this company No offense, in my opinion, I'm going to say in my opinion, so I don't get any lawyer calls. In my opinion, this company does a lot of fraudulent things. In my opinion, this post that you see here, right, they're doing well right now. They're doing well because they have availability of servers that the industry needs. But I'm hearing that server shipments are down for companies like Dell and HP. There are component issues that are causing problems in the channel. I helped you with that on Ericsson. We're going to get back to that in greater detail in a little bit, right? But so how is SMCI doing fine? Don't be surprised, and it wouldn't be the first time, so don't be surprised if we hear again in the not too distant future that they have availability of servers because they're putting Chinese components in those servers. Okay? At some point, they are going to get the Trump administration smackdown. So be careful with this one because I do believe they are doing well right now. The stock's doing great at the moment, but careful, dicey. Okay? And speaking of Dell, man, I mean, look, I gave y'all to TSSI, what, at $2? Yep, there's the buy right there. Okay? First one to prove that Elon Musk's XAI, now SpaceX, was using TSSI in their data center to build Colossus. Okay? And the stock ran. The stock ultimately peaked at $32 a share, above my risk reward high of about 18, 20 bucks. So I was only in from 2 to 20 and I was out and in at different times, but let's just say 2 to 20, right? And at that point, I was out, and then I was really out right around here when I came out and told you guys and showed you proof. And it was easy for me that Dell had built a facility multiples the size of TSSI's and had become TSSI's biggest competitor. TSSI's largest customer, in fact, basically their only customer, like 97% of revenue comes from Dell. Imagine 97% of your revenue coming from your biggest competitor. Does that sound like a great investment for you? I made the unprofessional mistake of saying that that was proof that that TSSI is Dell's biatch. Okay? I shouldn't have done that. It's unprofessional. Okay? But it doesn't change the fact that TSSI is and proven now to be Dell's overflow valve. I'm sorry, guys. You guys can hate me. You know, Dan can punch me in the hallways of the next investor conference. I won't even sue him. I'll just punch back. Just know that, right? But come on, y'all. You guys can't get past 14 million of systems integration revenue, even though you spent $30 million at Dell's behest to build out a much bigger facility to build more AI data centers, more racks. So where's the business? Where's the beef? Dell's growing. Dell's AI business has gone up, up, up the last 3 quarters. Yours has been flat, flat, flat. How is that possible? Oh yeah, that's right. Because Dell doesn't have to give you more business when they get more business. They can keep it for themselves. And I made the mistake of making a trade on this stock, and I know some of y'all got out because of what I said last week, okay? But the data points were positive. The parking lots were full. Everything I said was accurate, okay? Anthropic was building out Colossus in conjunction with SpaceX because they need compute. All of that is true. And it still wasn't good enough for this company to have a good quarter. And the lesson for me in this, personally, 30 years, I still learn lessons, is, and I knew this already, right? So my bet was really, really small. I didn't lose a lot on this. I'm making way more money on TPCS today than I lost on TSSI, right? Because I made a small bet on the quarter based on the positive information. And why, Mark? Why, with all that positive information, would you only make a small bet? Simple. Because my DCF right, tells me that this is not a company operating on all 10 cylinders. This is a company that is beholden to Dell and probably worth closer to 5 than it is 10. You heard me right. This stock is right now 10, and I think it's worth closer to 5 than 10. And by the way, yesterday the stock was 13. And I already believed that. When the stock was 13, I still believed the stock was only worth 5. I tell you that every time I'm on here. But I said because investors like to trade the stock and they like to keep the stock at 13, and I think there's a good chance they beat the quarter, I'm going to play the quarter. That was a mistake. But I sized it properly. Why? Because I was betting on a $5 stock that was trading at 13 already. Valuation matters more than anything. It is the gravitational pull on the stock. Ultimately, not today, not next week. Oh my God, I need to make money next week. I got better places to put my money. Listen, somebody in my community made that comment. I was so disappointed. To hear that. I have more fun stocks to buy. I have stocks that are putting a smile on my face, and I'd rather have my money there. Are you dumb? Is there a measure? Is there a ratio called the happy ratio? And stocks that make investors happy go up more? No. In many cases, the stocks that are making investors the most happy, euphoria, by the way, that's the synonym for happy, euphoria. What happens when investors are euphoric? It's a contrary indicator. Stocks usually go down when investors are euphoric, which is why I show you the bull bear, the fear and greed index. When people are greedy, that's when you want to get out of stocks. The market tanks when the fear greed index goes into greed territory, and people are greedy when they're happy. Oh my God, I was so disappointed. I'm disappointed in you. All right, so that's TSSI. I'm disappointed in you too. I may never put another dollar in the stock again. This was horrible. This was like, people say, it wasn't such a bad quarter. Yes, it was. It was a horrible quarter. Much worse than the Wall Street estimates imply. Those estimates were low anyways. You feel me? It was horrible because of what they should have been able to do given the demand in the environment, and they have no excuse for it except Dell hasn't used this for more than the minimum. But they said if we spend another $17 million on your screen, ladies and gentlemen, didn't they already spent 30? Spend another 17 and we'll give you some more business. Suckers. I'm sorry, I didn't say suckers. I didn't say biatch. I'm sorry. I need to stay professional about this. I'm giving you my professional opinion. I'm trying to keep it in a professional manner, all right, so that they don't hate me, right? They could hate the fact that I'm telling the truth. That's cool, but at least they should be able to respect that. And if they can prove me wrong, do it. Do it. I've been waiting. It's been over a year. Okay? Well over a year for you to prove me wrong. Get out of here. All right. We talked about this. We talked about this. We talked about that. This is my new pick, by the way. Y'all got this yesterday in your mail. If you didn't, then you haven't subscribed to my blog site, markhomestocks.wordpress.com. No sponsorships, no advertisements, no nothing. Okay, if you see advertisements, it's because I don't want to pay them the premium to remove advertisements. I don't get a dime. I don't make a dime off of YouTube. I don't get a dime off of this. If for some reason I make a mistake and somebody sends me a check for $3.22, I donate it to charity. Okay? I'm not accepting revenue or payment for anything. That's been my rule since 2015. Since 2015, I have not earned a dime for doing anything. And I'm going to stick to that till the day I die, God willing. CVV is the new pick. And we now have a risk-reward chart on these guys. As you can expect, it looks weird. It looks actually too weird. What's going on here? What's this? What happened to my risk reward lines? Something got messed up here. Oh, now it looks normal. That's weird. It must be some kind of logarithmic error. Well, that's what it looks like, okay? We're sitting here right near the green line. And in fact, the green line is actually below the asset value. Here's the thing that you guys need to know. This company has $23 million in cash. This company has a facility that's worth, I looked up the going market rates. This facility is worth like over $30 million. They have another facility worth $5 million. Add it all up, ching, 60 million bucks basically. Okay? They have less than 7 million shares outstanding. Carry the one. That's $9 per share. This company has $9 per share in cash and real estate. That gives no value to the business. And what is their business? They make furnaces. Okay, this is similar, like if you guys have been following me a long time, Intevac went from 5 to 35. They were selling equipment that provides, you see these precisely controlled gases, blah, blah, blah. This is semiconductor capital equipment. When you've heard, if you've heard of silicon carbide, if you've heard of me, right? Because silicon carbide really made air take off. Okay? That was the reason air took off. Silicon carbide testing. Silicon carbide chips in your Tesla. Silicon carbide chips now in AI data centers, right? And that's why my chart says EV gold mine, silicon carbide in EVs, and AI gold mine, silicon carbide in AI data centers. Now, they're expanding beyond silicon carbide, but that was the primary initial use case. Beautiful. Okay, cool. So, if you understand that, you'll understand this. The way a silicon carbide chip is made starts with the production of a ball of silicon carbide. Okay? This is not something that you just pick up at your grocery store. You need a furnace. I'm not going to explain it. You read the report if you care. Okay? But suffice it to say, this stuff is needed increasingly across the world for silicon carbide chips, right? The silicon carbide ball. And it's not easy to make, and it's getting harder because we're moving from 150 millimeter balls to 200 millimeter balls, and we're going to go to 300 millimeter balls. And the bigger the balls, the harder it is to make that ball uniform from the middle to the exterior. Think about a cake or a loaf of bread. Have you ever seen a cake or a loaf of bread where the consistency of the cake or loaf of bread is 100% the same throughout? Of course not. First of all, it's porous, right? It's like a sponge. There's like all these little holes in your bread and your cake. Disqualified. Second, that it has a crust. Disqualified. It has to be a perfectly, you get what I'm saying, right? No holes, no crust, just perfect. It can't be made, okay? It would be too expensive to make something like that. It's the same thing for silicon carbide. And the larger the ball, the harder it is to make it 100% perfectly uniform throughout. And why is that important? Because when they slice that ball into wafers, right, to make chips out of, those chips have to be on perfect wafers. Those chips have to be perfect. You can't have flaws. You can't have flawed diamonds. These have to be perfect diamonds, okay? So that's what makes it difficult. CVV's been doing this for 40 years. They have been in a dry spell, a rough patch, a nasty rough patch. They just reported like $1 million of revenue last quarter. So what? So did Air in 2015, right before the stock went from 1 to 6, okay? The reaction to Air stock, I got it up already. Was it Air? No. Wait a minute, what am I thinking of? Yeah, it was Air. But it was back here. Let's go. Oh, here we go. I got sidetracked because the chart confused me. Let's go to 2015 for AEHR. Here you go. That right there. You see that reaction? You see that stock ripping? That was the reaction to a quarter where they announced $1 million in revenue. In fact, the worst quarter as a public company, the stock started to rip. And 12 months later, it was 6. It went from 1 to 6 in 1 year, coming off of that trough level. Okay? That's what happens to capital equipment companies because if and when they do come out of their trough, the stock takes off, okay? And it doesn't get much worse than 1 million of revenue, right? So why only 1 million in revenue? You could have asked me the same question about AEHR. That's the cycle. And the cycle here is that silicon carbide, especially 150 millimeter silicon carbide bulls, became a commodity thanks to the Chinese. Sorry to any of you Chinese people out there. I love you, but you guys are just nasty when it comes to competition. Okay? The government subsidized the space. They bought a whole lot of silicon carbide furnaces back in the day, and they flooded the market with silicon carbide bulls. So that's a problem. Well, it's less of a problem now because the US government has said we're not buying silicon carbide bulls from the Chinese. We're not buying chips, we're not buying wafers, we're not buying anything silicon carbide from the Chinese. So boom, that's it, they're out. And at the same time, the Chinese government said, oh, okay, well then it makes no sense for us to subsidize our manufacturers anymore. We're not going to do that anymore. Okay, so now all of a sudden you start to see silicon carbide data points going upwards, which is why, in part, I bought into Wolfspeed, okay, and on Semi. And you can see those charts are, they're showing a little bit of trying to rebound off of lower levels because silicon carbide is rebounding off of lower levels. These are not huge positions, by the way, okay, because they're still getting off the mat. CBV is a huge position because I'm getting it for free. I mean, if all else fails, right? Oh, the part I didn't tell you, it's in the report. Their largest shareholder owns 20% of the company. There's another large shareholder involved, but that large shareholder used to work for Apollo. He was a bigwig at Apollo. Apollo's a buyout fund. These guys buy companies on the cheap and sell them more expensive. Okay? They fix them up and they sell them off. Oh, so you're telling me that this guy bought 20% of this company. Now, whatever can we imagine he might want to do with these guys? Exactly what he's doing. He sold off a piece of the business. He's renting out one of the real estate. I'm not saying the company's doing that, but make no mistake. I guarantee you it's at his behest. I guarantee you it's because he built up this large position and said, time for y'all to change. You guys have not been operating this business properly, just like what's happened to TPCS. And you see what's happening to that stock, okay? If things don't work out, they're just going to liquidate. And we're going to get $9. Plus whatever they get for the actual business, the patents, the 40 years of expertise, okay? All that gets broken up and sold off. Okay, it's a win, a small win. It's not a real win. The real win is if we get up to the green line level here, right? Where the stock rips and triples. It can do that, okay? Because we can start seeing the business bouncing back now that silicon carbide is bouncing back. I see connections between them and onsemi, connections between them and Wolfspeed, connections between them and Coherent. If you haven't heard of Coherent, then you're not that deep into AI. There you go. There's a long-term chart. Let's zoom in just so you see what's happened to this stock over the last 2 years. This stock was $30 a couple of years ago. Now it's $330. Thank you very much. All I need to know, all I need to tell you, okay? Optical transceivers, and there's a connection here, and we're working on that. This was a 2-month research project, maybe more. This is one of the hardest companies I've ever worked on because there's so much stuff going on in this industry to figure out what's happening. But at the end of the day, I found enough that's going on, and in particular, it was only in the last few weeks I heard about silicon carbide bouncing back. Okay, cool, check. Right, first inning there. The other part is the CMC business, okay? That's not silicon carbide. That is ceramic matrix composites. It involves silicon carbide, though. You put silicon carbide, you mix it with carbon, you mix it with other things, and you basically create this composite that is much lighter, stronger, and heat resistant than nickel alloys, which have traditionally been used in aerospace and defense for things like hypersonic vehicles, missile aeroshells, space plane components. Last time I checked, hypersonic missiles, space planes were all hot. Okay? But on top of that, like those are all growing areas, but on top of that, there is an upgrade cycle in the turbine engine space. Now, part of this, what I haven't tracked down, is how much of this might be relevant to what's going on in AI and the fact that they need power for their data centers. You've heard about them buying gas turbines, maybe even buying Sprint airplanes because of the turbine engines they have. But make no mistake, GE is going through an upgrade cycle for their LEAP engine. You can read it all in the report, okay? And they are CVV is the vendor of record for GE when they are building out their CMCs. So we have here basically a lot of ways to win. Silicon carbide, CMCs, the ceramic matrix composites, a buyout, a breakup, a special dividend, you name it. There's a whole bunch of ways to win and not a ton of ways to lose, right? So they fit in that bucket of companies that are too cheap to not own. And you've seen what's happened to a lot of those. They get off the mat, they bounce off the green line, and you win. Sometimes you win huge. I mean, you saw Air was a $1 stock at their worst quarter, went up to $6 in the next year, and is now like 136. These things happen. It doesn't happen with every stock. I'm not saying this is the next Air. I don't do that. Every company is a snowflake. But I'm telling you that that's why a huge chunk of my portfolio is dedicated and allocated to names like this. Let's keep moving. We'll talk about it more in Q&A, I'm sure, which hopefully will be happening soon. I'm picking away at these. I got all these things to talk about. Let me see. Is there anything else I need to talk about here? We talked about the shortages, the servers. We got a few other stocks to talk about. I'm going to talk about a company called D-Box. We're going to talk about Crescendo. We're going to talk about IDN, which is down like 25% today. We're going to talk about Intermap. And we're going to talk about all the names that are up here in these tablets. So let's get through this real quickly. Gatekeeper, another win. You can look this up yourself. $3 million. That's a tenth of their whole year last year in one contract. And they keep announcing deal after deal after deal. They're operating on like 11 cylinders, folks. And they're not trading it. Look, the 10-cylinder level is currently at 269. The stock is trading at 128. And oh, by the way, they broke the 200-day moving average. I told you not to worry about 200-day moving averages, stupid. And now you've missed it. Now the 200-day moving average is now a support level, and the stock is near that level. So when you get a breakout, what there usually is a test, and we're getting that test now, right? You get the breakout, and then you get the test of the former resistance, now support level, and then you get the stock taking off. This stock should be closer to 250 than 127 right now, based on what they're doing. Big gap between execution, cylinders, and risk-reward positioning. Okay, next. Tech, oh my. I mean, look, I already talked about Tech Precision a little bit, but this quarter was amazing. Like, really, if you've never listened to an earnings call, listen to me. Wake up. If you've never listened to an earnings call, download the Quarter app. It's spelled like quarter, like a 25 cents, but no E at the end. No E at all. Q-U-A-R-T-R. Quarter. They let you listen to earnings calls in real time and after the fact. Download the app, type in TPCS, listen to the last earnings call. It's like, 25 minutes or something. Amazing. These guys, the activists, turned this company around. By the way, thank all of you who voted the old board out. I remember telling y'all, like, we're not a group. I'm just telling you, I'm voting these guys out. I hope You guys are too, but I can't tell you to do that because then that would be illegal. It happened. They got out, the activists got in, and they said, all right, things are going to change now. Because if they don't, next time, we're going to get rid of the rest of the board and the CEO. And then the CEO goes, me? And they said, yeah, you, stupid. And okay, maybe I'll get on a plane for once and try to fix this business. Sorry, Alex, for making fun of you, but you deserve it. You deserve it because until the activists took over, you weren't doing the stuff you're doing now. You just weren't motivated. I'm sorry. I get it. I'm 56 years old. You're a little older than me. I don't want to do shit either. But you're being paid to. And now you're finally doing it. 23% growth year over year. Their third straight quarter of sequential growth. Record backlog. They didn't even say it in here, but it was record backlog. They did $9 million. $52.7 million of backlog. We're going to go to the model in a second and show you what this means. Their guidance for EBITDA growth, $4 million. The stock yesterday was trading at 48 million. That's a 12x multiple. That's like, the equivalent basically of a 12 PE for a company growing at 23% on the revenue line. The EPS line is at a much faster rate because of the operating leverage I've told you about. This 4 million, I think, easily becomes 12 million over the next 2 years. So not only is it cheap off of the 4 million number, it's 3 times cheaper off of the 12 million I think they can do in the next 2 years. And they're getting help, my friends. They're getting help from that's not what I expected. They're getting help from Donald J. Trump. These guys, this is a memorandum. This is Wall Street. This is Wall Street, not Wall. WhiteHouse.gov. This is White House. This is Donald Trump saying it's a memorandum directing the Secretary of War to establish a 5th naval shipyard, the first in over 80 years, to increase the nation's submarine. Enough said. Submarines. Okay? And that's what these guys have been helping to build. Among other things, Virginia and Columbia class submarines. This is my model. You don't see models like this, okay? My model is broken down by the things they make. Virginia subs, Columbia subs, F-15EX fighters, the F-15IA, which is the Israeli version of the F-15EX, CH-53K King helicopters, King Stallion helicopters, okay? And in this model, I go through the 300 plus government budget pages with the help of AI to find the line items of how many of each of these they want. And I find out from my industry sources how much TPCS makes on each one of these things. And then you just multiply them. It's real simple. I'm selling 10 of these at $10 each. I'm making $100, right? That part's real simple. The hard part is finding the numbers of how many are they going to sell and how much are they going to make for each one. And once you have those numbers, then you can say, oh, these guys should be making a lot more money. And look what happens. 3 quarters later, they're making a lot more money. They go from 7 million to 8 million to 9 million in successive quarters. The stock starts ripping. They're operating on a lot of cylinders. It's still not fully priced into the stock, but that's cool. It's moving in the right direction, like the company. There's a lot going on here, by the way, too. They finally are looking for new business. So beyond what's in this spreadsheet, they're talking about 33% of their revenue coming from stuff that isn't in the spreadsheet in the future. Okay? And if 33% of their revenue is coming from stuff that's not in the spreadsheet, that is a 50% increase to the numbers in this spreadsheet. If they achieve that, I'm not baking any of that in. You see? 0, 0, 0, 0. Okay? But if they start to execute, I'm going to have to start modeling it. If they start to make extra money, and they indicated on the earnings call that that's happening. They're getting new business from new customers. They're getting more business from their existing customers. I didn't bake that in either, except I think there's one place in here where I've got that happening. And not even to a huge extent. You see here, increasing the revenue per unit, right? On the submarine side. So there's a lot of ways this model can actually expand from here, okay? On top of that, they were asked on the call if their West Coast division would start getting free money like their East Coast division has been. Wait a minute, Mark, what are you talking about, free money? Yes, the U.S. government, the Trump administration, has given TPCS, and look up their market cap, because what you'll find is that the U.S. government has given them $24 million. That's half their market cap of free money to buy equipment. Do you think they did that for fun, out of the goodness of their heart? Or do you think they did that because they want them to buy equipment so that the government can give them more business? What is success? So boom, they were asked about that on the call and said, can you get that in your West Coast division? Because the East Coast is where they make subs, and we know that Trump wants subs, and we know Trump is willing to give money for subs, so it's no surprise that you got money, though it's cool that you got it. Can you get money for the jets and the helicopters? And the CEO started to talk, and then the CFO told him to stop. That basically tells you that the answer is yes. Okay? They just can't talk about it yet. And then Ross Taylor, as you see on the screen here, who, if you've been following this company, Ross Taylor has been hilarious. Quarter after quarter, year after year, beating this company up as they deserve. Every single quarter has been hilarious to watch. This quarter, not hilarious to watch. Why? Ross Taylor didn't have anything negative to say. In fact, he's telling them, you guys are doing great. I mean, like, I was shocked. It felt weird, right? Having Ross be complimentary of this management team. But he also said that based on the demand that he sees out there, that it cannot be completed. The F-15EX cannot meet the demand around the world, building 24 per year. He thinks it needs to go to 70 plus. Boeing has already said they're expanding their capacity to 24 for this year, which we already knew, 24. But Ross is saying, no, it should be 70. Okay, well, I found proof that Boeing is expanding the capacity from 24 to 36 with upside for 48. Okay, so Boeing already knows that they need the capability to deliver 48 unit run rate, right? 4 per month. And the true potential is over 70. That's not reflected in my model. The biggest number in my model is 2030, 32. They make they get close to $1 million for each one of these. So if this if this 24 turns into 36 and this 32 turns into 42 or 52 or 70, this just adds to this model. And look what I've got them doing $1 in 2 years. I've got them doing $2 2 years after that. If they earn $1, if they grow from -16 to 60 to $1 on the way to 155, my friends, the stock is not going to be trading for a 10 or a 15 PE. It's going to be trading, in my opinion, for at least a 20 PE at that dollar. That's $20 per share. Okay? Which makes sense, because if they're moving towards $2 of EPS a couple of years from then, why wouldn't you pay $20 for a company that's going to deliver $2 of EPS 2 years later? Okay? And let's not forget, this is a company that has executed poorly because nobody was holding them accountable. And now they're finally executing. Look, this company's done well over the years. If you look at the long-term chart, right? They just got lazy and stupid board of directors. Good riddance. Bye. See ya. Right? But if they were executing, GHM, Graham, this is the poster child of what execution looks like in an industry, the defense sector, that is getting as much demand as it's getting. This company, Graham, I've known them for years. This company's gone from 6 to 106 and beyond. It's 113 now. This is what TPCS should have been doing. Okay? And now they're finally starting to Get with the program. All right, boom, there you go there. That takes care of that. That takes care of that. Let's keep going. Radcom, got to talk about them. This is big. I plan on releasing a report. Oh, I can't really show you where it is. I planned on doing that. Or is it here? Nope, that's Energous. We'll talk about that in a sec. Updating my subscriber base, free subscribers, by the way, of course, always free, on what's happening. I spoke to management, the CEO, after the earnings call. Dude, things are going great, okay? The whole reason that they had a tough quarter was because of those component shortages I talked about earlier in this broadcast, okay? That's temporary. It's transient. It's not a problem. So how is the business? The business is great. You see what's happened. We got an upgrade from a renewal from one of our customers, and we stole 2 customers away from their incumbents. Now, what you need to understand is that there's a limited number of telecom carriers on the planet, and they are very reticent. They do not often change who they do business with. They take forever to make a decision, and then they stick with it. So to see Radcom stealing customers away from incumbent carriers is a validation of what I wrote in the initiation piece that you can find on my blog site. That AI is driving a transformation in carrier networks where they have to upgrade to 5G, real 5G, not this fake 5G that you see on your phone. When you see 5G, that's a 5G antenna. That does not mean that the call is being routed through a 5G core network. There's a difference between an antenna and the inner workings of the network. And we're seeing those upgrades take place. And AT&T planned on significant network upgrades that were going to lead to Radcom getting more business. The more the network gets upgraded to 5G, the more Radcom gets business. That's the way it's always been. AT&T has been a growing customer over the last 10 years since they stole them from NetScout, the biggest player in this space, all those years ago. Well, things aren't changing, okay? Because the top vendors, NetScout and Viavi, both public companies, have been working hard and spending extra R&D money to not only keep innovating their old way of doing things, but also to try to create some new stuff to hold on to their customers. Well, Radcom 10 years ago said, forget all that. We're going to make the best future-proof technology now across the board. These other guys can't do that. They can't match what Radcom has because, 1, they don't have the experience. 2, they're too tethered to their probe-based heritage. You can write that down and ask AI what that means. But the bottom line is, NVIDIA is dealing with Radcom now because Radcom helps their equipment operate 4 times more efficiently than the competitors do. 4 times. This is not like 30%, 50%. That would be good. 30%, 50%, that would be good. Now, 4x is crazy. Okay? And that's why Radcom has never, they're undefeated in greenfield operations. If a company decides to form, Rakuten decided to form a carrier, they want to, look, there's a great opportunity, 5G is coming, we want to be a new player in this space, that's greenfield. Who are we going to use for our equipment, our network, blah, 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 all that stuff? They chose Radcom. Radcom's undefeated in greenfield opportunities. Okay, and as these carriers say, it's time for us to upgrade to 5G, Radcom's winning these deals. It's one of 2 things happening. Either NetScout is holding on for dear life, Viavi's holding on for dear life, and they do a pretty good job because they're so big. But those smaller, all the other players beneath them, they didn't innovate. And so Radcom is now eating their lunch, around the world. Okay, so these small wins that they got, these small steals that they got, those small carriers are part of larger carrier groups. So as the Radcom deployment happens and the carrier actually sees what Radcom can do for them, as AT&T and Rakuten already have, they're going to expand into the full groups. I believe that both of these wins are going to end up being $10+ million per year recurring revenue businesses for Radcom, who just reported 11.7 for the quarter. They're on like a $45-50 million run rate. And each of these wins can add another 10 million, another 10 million. And by the way, once these component shortages and price hikes are baked in, that's another 10-20 million from their existing customers who want to move forward with expanding what they're doing with Radcom because of AI. And it's not the shortage that we need to worry about. That's great news. The problem's not the shortage. The problem is the price hikes. Okay? Because now some of the servers are selling for 3 or 4x because the components, most notably the memory, has gone through the roof. Now you would say, well, shoot, then doesn't that mean that the carriers won't buy anymore? No. What it means is that their 2026 budget is effed because the line item that said servers did not plan on 3 or 4x increases in pricing. It significantly hurt their ability to say, dude, we can only buy 1/3 as many servers as we wanted to because the price has tripled and we don't have budget for more. Okay, so cool, let's do that for now. But the 2027 budgets are now being written up. They're now being drawn up and they have the new pricing involved. And by the way, they can place purchase orders ahead of that. So Radcom, they're going to be Gucci real soon. In the meantime, investors have by the way, how many cylinders are they operating on? I would tell you that they are operating on close to 10 cylinders. Okay? But what about the shortage? I get that. But that's beyond their control, transient, temporary. I don't necessarily call that a rough patch. I call that like an act of God, right? If a company, if there's a hurricane, right, and companies in that area can't operate for a few days, that's not a rough patch. That's a act of God, temporary shutdown. They'll be back in business no time flat. McDonald's shuts down for a few days and they're serving burgers a few days later. No big deal. That's what we're dealing with here, okay? So here you have an opportunity where other than that shortage that's going to go away, this company is rocking and rolling. And yet it's trading at the green line level. They have $6.50 of cash. Okay? 2/3 of the market cap is in cash. And what did Money Mark say last week, the week before, etc. about this? That the activists who took over, there's that word again, activists come in and they make great change for companies. One of the reasons the activists got into Radcom is because Radcom, for some reason, look at the market cap. RDCM market cap is 173 million. These guys are doing about 50 million, 60 million, 70 million of revenue. They're profitable. In this crappy quarter, they still pulled over $1 million of cash flow. They have more cash now than they had 3 months ago, despite what's going on. So why are you guys keeping $110 million of cash on your balance sheet? That's dumb. Give that back to us. Do a buyback. Something. See, this is what 30 years of experience will get you. Board and management moved to establish a $20 to $25 million buyback. I told you this would happen, and now it has. They're doing a buyback. They have a temporary problem going on. It's going to go away. They're stealing customers away from former incumbents. They're expanding. AI has the wind at their back. What else could you ask for? I'll tell you. Big surprise. This is huge. If I was telling this to Wall Street customers, the stock would be up much higher today. Back in my Wall Street days, customers would actually move these stocks for this reason. I'm hearing that Radcom is in position to steal one of NetScout's, NTCT's important customers. Okay? And I don't know, maybe other people's started to hear about this because the stock has seen some bump in the road here. But I suspect that this is more about components than the risk of them losing another customer. They lost AT&T 7 or 8 years ago. Another customer to Radcom, which would galvanize what I said about Radcom being the absolute best of breed company in this industry for AI. This is the AI service assurance player. And yet it's trading down here, not at bubble levels like air, but at trough levels like they're doing bad or something. No, they're not doing bad. They're doing great. And I think it's about to only get stronger and stronger. And the fact that I'm hearing that there's a customer seriously considering moving to Radcom, and I use the word seriously loosely, lightly, I should say, that is tremendous. If I was NetScout, I would acquire this company immediately because you're basically paying 70 million bucks, 60 million bucks of enterprise value because they got 110 million in cash for a company that generates more than that per year in revenue profitably, has so much operating expenses that NetScout could cut out that they could, in my estimation, generate probably, I would say, over $40 million of cash flow if they acquired Radcom. I think NetScout could generate $40 million in cash flow from Radcom if they bought this company. $40 million in cash flow. What's that worth? At least $400 million. Add the cash, that's $500 million. What's the stock at? $170 million. That's a triple from here, ladies and gentlemen. And that's why you shouldn't be surprised that my red lines up here for M&A is triple where the stock's going for right now. Okay? And the reason that I've been emphasizing this so hard is because I noticed something this week. We're going to talk about WATT in a second, right? Let's see if I'm done with this. Maybe we'll talk. Vertra, business as usual. It's getting a little bit better. Not so exciting. You see the stock. Somebody asked, why is the stock not reacting to the quarter? Because it wasn't a great quarter. Yes, they showed some signs of maybe getting off the mat, right? But I got to talk to John, the CEO. I have a regular dialogue with him. I haven't had a chance to. I've been up till 1 a.m. every night because of earnings this season. And VTSI, when I saw the press release, I'm like, this can wait till next week. And that's what's happening. That's what investors are saying. This can wait till next week. All right. So that's VTSI. All right. We got Radcom. I talked about that. There is the, you can look this up yourself. This is them stealing that. But look, for AI-driven assurance. Okay. This company who was already doing business with another company, you'll see it in the article that I release soon, selected Radcom for AI-driven. This is an AI company being treated like garbage. Done. Next. Energus. Watt. I performed an experiment this week, and it didn't go well, but at least I learned something from it, which I needed to. I needed to understand this. When I pick a stock, right? People go crazy on it on day one, and then it just fizzles out. And then sometimes I come and tell you, gatekeeper, 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 right? When gatekeeper was in a rough patch and the stock was going down, and I said, whoa, 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 I think the rough patch is finally over. Okay? When there's a rough patch, everybody's happy to sell, 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 sell. But when the rough patch ends, people aren't so quick to buy. Why? Why? Why is it so easy for you guys to sell something, but not so easy to come back to it? That's dumb. And I know it's human nature. I'm scared. I told you a million times, there's no room for scared. There's no room for fear. There's no room for emotion in stocks. The people who act like Mr. Spock make the most money. I am Mr. Spock. I don't give a F about you. Okay? I'm here to make money. That's the attitude that happens, right? I don't care about you, Mr. CEO. I'm here to make money. Tell me what's going on at your company, and if I don't like it, I will have you fired. I don't care. I'm here to make money, right? You're a company with a stock. That means you're my employee. I'm your boss. Work for me. Okay? Why is it so easy for you to sell, not so easy to get back in? That happened back here when I told you to buy at 30 cents. A lot of people didn't. People were buying at 60 cents after it doubled, buying at 90 cents after it tripled, buying at $1.20 after it quadrupled. But they wouldn't buy at 30 cents when I told you to. A guy, me, that for 30 years had been doubling my money every 2 years. And you've seen it with your own eyes for the last 17 years that I've been publishing my articles live. You guys need to get past that. This stock shouldn't be here. Gatekeeper. Radcom shouldn't be here. TPCS shouldn't be here. Right? It's crazy. Energus. So what I did was the experiment. Going into the quarter, I didn't say anything at the time, right? But I was a little concerned about the component shortages that I'm seeing with other companies, and I know what Energus needs components. And so without wanting, I didn't want to cause a panic because I didn't know something was happening, but I knew the stock had just ripped, okay? The stock had gotten down to the 50-day moving average, and people started to pile back in, right? And as a result, and by the way, the AWS deployment started ticking back up again. It ripped, right? So the fundamentals look good. The AWS looked good. The chart looked good. Everybody, okay, let's go. All right, let's go. That's cool. The stock went up 54% in 15 days ahead of the quarter. Okay? That's a lot. 54% in 15 days is a lot. So between my concerns and the fact that the stock had gone up 54% in 15 days, if you make 54% in 15 days and don't take some profits, I don't know what to tell you. So I decided, let me take what off of the spreadsheet temporarily, right? And see what's going on and see how this works, how people react. They reacted bad. The stock tanked really quick, and you guys get scared fast, right? And then they come out with a quarter, and it was a great call and everything, right? But the stock's been very volatile, as you can see. Boom. Look, there's me taken out of the spreadsheet. There is the reaction immediately. There is the earnings report. There's the stock going up, and now the stock drifting. It's going all over the place. People are trying to figure this out, and so am I, by the way. Okay? Bottom line is, you guys need to do better. I do this show to teach you how to make millions. And when you guys are reacting like this, that's telling me that you are not learning those lessons and you're not going to make millions that way. Period. All right? As far as Energus right now, I am working, since I took it out of the spreadsheet, I'm like, you know what? Since I took it out of the spreadsheet, let me do some more math. Let me do some more research. Let me talk to management. I did that this morning. I need to process it. Okay. There's a lot of good things going on. This should not be green. Boom. Okay. I'm more excited about this company than I was a few months ago, but I need to quantify that to figure out what's the right DCF, what are the right estimates, all that stuff, right? And so we had a call today. I'm working through some numbers. There's a lot going on. There's a lot of activity. They're not saying it, but they got McDonald's as a customer. They got the U.S. Postal Service as a customer. They got Walmart. They got Amazon. They got Whole Foods. They have all these customers. And I need to figure out how much each one of them is worth in terms of revenue so I can figure out what the DCF is. What's the stock worth? So I'm going to take this experiment and use it to take the time to do that research. So stay tuned on that, right? But in the meantime, where did I go? Here we go. I've got this article that I'm working on. Okay. The first Walmart chapter has closed, just about. They're 90% through their first phase of the Walmart deployment. It actually worked out as they At first I was like, really? That seems too soon for me. They were supposed to make like $10 million off of Walmart. And then when I went back and checked my notes and did some math, and I realized, well, they've made about $9 million off of Walmart right now. And they said on the call that they're 90% through with Walmart. Phase 1, not done with Walmart, but phase 1 of Walmart. And, well, 90% of 10 million is 9 million. Okay, it makes sense. That tells me they've been telling me the truth. That's a positive. Okay, now I need to apply that math to some other customers and see what's going on. But in the meantime, they have more customers ramping up. They have more opportunities at Walmart. By the way, phase 1 might not actually be over because Walmart, you see, the phases are the stores, the distribution centers, and the trucks. Those are the 3 phases that we're dealing with at Walmart. They're not saying Walmart, by the way, but it's Walmart. And they already, all 4,700 stores have Energus equipment in it now. But it could have a lot more Energus equipment in it with other use cases. So this is not actually done. This could continue further. And these 2, we're waiting to see these things ramp up. This one, to me, the most exciting because they've got like, let's say including third-party trucks, let's say 100,000 trailers out there delivering Walmart product all over the world. Those trailers would need 3 Energus boxes. Those Energus boxes cost $200 each. That's $60 million. Not 9, not 10, 60. But that's not coming today or this quarter, and I don't think it's coming next quarter or the quarter after that. It's phase 3. That's somewhere in the future. We need to figure out how far in the future. We need to figure out what the odds are of it happening if it happens. Okay, so there's a difference between opportunity and odds. So there's a lot going on that I need to work through. And at this point, I would rather work through that before I add this back to the spreadsheet. So stay tuned on that. Oh, we only have a half hour for Q&A. As a result of that, I am going to not talk about D-Box this week, but this is a great post. You can look it up for yourself and read that. Okay. I'm not going to talk about Crescendo this week. I'm going to save that for next week, but suffice it to say, I think these guys are operating on close to 10 cylinders. And here's the chart. They're only getting a 3 or a 4 on this chart. 3 or a 4 versus 9 or a 10. This stock is a screaming buy. The technicals are beautiful. The technical channel, they're at the bottom of the technical channel. They're trading. So fundamentally and technically, this stock looks great to me right now. If you don't own Crescendo, my personal opinion is that you're stupid, but I'm not telling you to buy it because I don't do that. Intermap. We're going to get much more in depth on these names next week. I just need to get to Q&A. Intermap. You see not much action here on the stock, right? Because there was not much to see in the quarter. To be honest, this has been, I'm glad we got out near the risk reward highs. Okay. We took most of our money off the table. When you get close to a 10 on the risk reward chart, you're supposed to get rid of almost the whole position. Okay. If not the whole position. And we had a hell of a run here. Intermap, still in the spreadsheet, I believe. Yep, there it is. And if you don't know how to take profits, but you know how to buy stocks, when I put it in the spreadsheet, you bought at 40 cents and it's now 72 cents. You're up 80%. That sounds great, but it's not great. It's terrible. I mean, yeah, 80% is great, but it was up 550%. Okay. So it was up 550% at a level that the rules clearly say, take your profits off the table, at least your profits, if not the whole stock. So if you're like me, you made closer to 550% than 80% on this stock. And since that time, we've been waiting and waiting and waiting and waiting for this Indonesian contract and Malaysia and a bunch of other stuff. Dude, what's going on? Why can't you guys get these big contracts? Why is it taking years longer than you're implying for these contracts to come in? That's a problem. Okay? But I will tell you one piece of information that came in that was interesting is that in this Indonesian process, I told you a long time ago that the Chinese were mucking it up. They've been mucking it up. And as it turns out, F you, you guys can sue me if you want. You Chinese vendors have been lying to the Indonesians, and they're finding that out. I said it. They're lying, and they're finding it out, and now it's actually working. Ultimately, going to work in Intermap's favor. Ultimately, how long is it going to take? We still don't know. But ultimately, these Chinese vendors are not going to be allowed to do anything for Indonesia because they've got caught lying. So whereas before they might have gotten some of the business and Intermap, maybe they got 50% share or 80% share or 90% share, they're going to get more share now because the Chinese are going to get goose egg. Okay? So all else being equal, that's positive for the company. We just still don't know how long it's going to take before this all plays out because they have to, Indonesia has to cross their T's and dot their I's because the World Bank is funding this. So they need to explain to the World Bank why they're not giving this business to the Chinese that look like the better vendor. Well, they looked like the better vendor because they were lying. But we need to find proof and document it all the ways you want. So stay tuned. So there, I actually talked about Intermap. I didn't plan on doing that. And IDN, I have to talk about this a little bit because these guys are idiots. I'm sorry, Brian. I don't want to call you an idiot. That's not professional. But I'm being metaphorical, okay? Your lawyers are idiots. These guys put in a 10Q that they've got a huge customer, over a quarter of their revenue, that told them that they are going to start using another vendor for 75% of what they use IntelliCheck for. That's why the stock's down 26% today. But what they didn't tell you, and this is funny because the lawyers were happy to tell IDN, to tell us that they've been told that this large customer is taking 75% of their business away. But what the lawyers didn't allow them to say is, one, it hasn't happened yet, especially not in the time frame. Like, it was already supposed to have happened, and it hasn't. They were waiting for it. They're like, oh, yeah. They got their hands up in front of their face waiting for the punch, and the punch isn't coming. Like the customer is saying, oh, psych, I lied. Okay? And why? I'm hearing that the new vendor that they're supposed to be using, the customer's supposed to be using, the stuff doesn't work. The stuff doesn't work. But guess what? We should have already known that. You should already know that because we did the research on IDN. And yeah, I took it out of the spreadsheet at $6.61 because I thought that was the right decision. And guess what it was? Because it went from $6.61 to $2.61. Okay? For good reasons. But this is crazy because the lawyers really messed this thing up. Because it's nowhere near as bad as it looks, in my opinion. Could they still lose business there? They could. But IDN has the best solution in the marketplace for what's going on. So this, to me, is clearly an overreaction. Clearly, to the point where I put my money where my mouth is, and I bought a bunch of this stock at these prices. Hereabouts. Okay? I believe this thing is overblown. It's going to blow over. I think they're going to have a great Q3. I think they're not going to lose this customer because the competition doesn't work. That's not going to be repaired. Okay? And in the meantime, while IDN waits for the punch, this customer is actually using them more. These are the crazy things that happen on Wall Street, and unless you have the ability to get the inside scoop like I do, not insider information, but the inside scoop, right? Calling contacts in the industry, what's going on? Who's the competitor? Those guys, that stuff doesn't work. Let me check with other contacts. What's going on? Yeah, it doesn't work. Of course it doesn't work because I was told by this guy it doesn't work. It doesn't work. This stock doesn't belong here. That's dumb. Okay? More to come on that in the future, but we need to go to Q&A. So let's go to Q&A. We only got 20 minutes for Q&A. Question mark, question mark, question mark at the beginning. Okay? I'm going to skip everything else. We don't have time for this. And then we're going to go into the lightning round somewhere around, let's say 10 minutes from now. We'll extend out a little bit. TPCS, what do you make of the debt problems? What are you talking about? What debt problems? They had $7 million in debt 3 months ago. They have $5 million in debt now. They paid off $2 million of their $7 million in debt. It's the opposite of what you're saying, my friend. Opposite. When a company is heading towards making $1 of EPS, they don't have a debt problem. A lot of companies have debt. That's not a problem. Next. Thanks for all the comments, by the way. I will read them all after the show. So please put the comments in there. Please put the kudos in there. Please give me the thumbs up. That's the only thing I ask. No sponsorships, no advertisements, no nothing. The only thing I ask is that you give me a thumbs up and tell people that there's somebody here that's not one of these 10,000 clowns, that's not colleges that rip you off, that's not CNBC that's ripping you off. These are all rip-offs. And I'm here to help you with that. And if you stick around long enough, you're going to learn that that's actually true. That I'm teaching you the real way this stuff works. And yeah, a lot of times my stocks go down when I initiate on them or have a bad quarter here and there. So what? I'm up 100% this year. I'm up over 40% year after year after year after year. That's doubling your money every 2 years. If you do that with $10,000, you're a millionaire in 12 years. Does that sound bad to you? No. And I've been proving it year after year. Anybody that's been following me can put it in the chat. Type hell yeah in the chat if you can validate and verify what I just said, please. The rest of you, give me a thumbs up if you appreciate that somebody like me is doing this. The stuff that I used to charge Wall Street 7 figures a year I was getting from Wall Street for my stuff, I now give away for free to y'all, my way of giving back to society. You closed out IDN because of the pop last year after yesterday's earnings. Do you think, yeah, I talked about that already. Great question. Mark, do you think Anthropic IPO could mean we are close to a top? No. No, it doesn't mean that. It could. But no, don't think about that. Those are clowns. Those are clowns filling your ears. Stop listening to clowns. You have to find more people like me, right? No offense. I gave you the 3 criteria at the beginning of the show that you should look for in somebody that you could actually trust to listen to. And this is the most important, right? This is my resume. This is what tells you that I am an expert on technology. Not, I've been following technology for 4 years, well, with my stock account. No, I've worked in technology. And I was... No offense, I'll toot my own horn. I was so good at it that I was able to leave, start my own company, that Wall Street wanted my picks because of my expertise, and I retired from that business in 4 years. A multimillionaire. Done. Age 38. I started the business when I was 34. I closed it when I was 38. Okay? Those are my credentials. What are yours, Mr. Clown? Stop listening to clowns. Would you hold TSSI through this? No. TSSI, I know. I already talked about TSSI. With Curry, if we get a decent pullback, would you consider? If we get a, if and when, ask me the question when the if happens. Okay? I'm not loving, I don't like Curry right here. All this did was give you a chance to get out. This has disappointed me ultimately. Okay, mainly when I saw the management incentive program, it's too dilutive. I'm out of there. I haven't gone back. I don't think I'm going to go back into it. Yes, they've got a great business going on, but they're paying the CEO too much. That's how and the Curie, it's the next question, their earnings report. Great earnings report. But this is a lumpy business. So it was a good lumpy quarter. The next quarter could be a bad lumpy quarter. It doesn't matter because the CEO is getting paid too much through his incentive program. Period. End of story. If I was advising a relative, because I can't advise y'all, I would tell my relatives, get out of this stock. What are your thoughts on the robotics theme? It's real, but that doesn't mean anything. What matters is what are they worth? And I haven't had time to get into that. We're too busy with AI to get into robotics, and I know they're interconnected, but I mean, dude, up till 1 a.m. every night this week. Fine question. Nothing wrong with that. I was talking to a buddy of mine who's in charge of setting up the data centers for NVIDIA. Oh, I love this. I love this already. All right. Those of you who work in industry, you are my lifeblood because I am a stock analyst. I do math. I take data points from around the world, from industry, and I turn it into math and turns it into stock investments. Okay? So when I get somebody that says to me, I was talking to a buddy of mine who is in charge of setting up the data centers for NVIDIA, my ears perk up, and yours should too. These are the data points that we want. Let's keep reading this. In my area, he was telling me that I should think about looking into investing in e-waste companies. I mean, all right, this is going to get too involved, but what you need to do, brother, is get me a list of publicly traded e-waste companies related to what your buddy is talking about, and then we can have a conversation, because it's not a real question here. But I am not familiar with this industry at all to answer your question. CVB, what gives you confidence in the volume and timing of potential GE orders? Read the report. Read the report. The fact of the matter is, I'll give you an idea. I can't tell you the timing. Right? This is the thing. When you're getting a company for less than its value of its cash and real estate, you don't have to ask that question. I would love to answer that question. I would love to. I spent 2 months trying to get the answer to these questions. I can't. Okay? But what we know is this. GE is ramping up its LEAP program. Look it up. Google GE LEAP engines. It's ramping up now. Okay? And as that ramps up, they are going to need more equipment. They're going to need more CVV stuff. How do I know? Because CVV is the customer they use for CMC. And they haven't switched vendors. Why? Because that's not something that customers do in this industry. They don't switch vendors very lightly. As long as the vendor continues to operate effectively, they don't switch. Because it's too hard to do that. It takes years of qualification to do. That's where my confidence comes from that standpoint. Did I talk to Watt Management today? I told you already. I think you spoke to IZEA Management after the earnings call. Does the lack of execution change your opinion of them? No. It could have been better. I was disappointed with the quarter. Make no mistake about that. But look where the stock is. Okay, basically at the green line. All right, so yeah, not operating on many cylinders right now. I'd like for that to change. I'm hoping for that to change, but this is no different than TPCS when they were at the green line, and look at them now. Okay, this is what happens. Radcom, the last time they were at the green line, you see what happened? Look at that. From 750 to $17 in no time flat, relatively speaking. This is what you guys got to learn. Stop being afraid. Stop basing your decisions based on the company is cool. The company's beating earnings. You make your investments on the basis of what's the company worth versus what am I paying for the stock? What is the risk reward? That's the winning formula. That's what made Warren Buffett the richest man alive. And it can make you the richest man alive, or lady, if you follow those rules too. It's the cheat code. Okay? And if I wasn't happy with how much money I have, if it was a contest, I would put all my money in the market using the same method I use and keep multiplying my money to the moon and become the multi-billionaire that he is. But I bought myself a penthouse. I gave some money to a money advisor to keep it safe because I don't want my life is as good as it can possibly be in my opinion. My life, I can't imagine, I have all the money to buy anything I personally want. And all I need to do is make sure I don't F that up. But if you want to go for it like Warren Buffett did, you can become the richest person on earth because Warren Buffett started with a paper route. No money. Okay? True story. Look it up. AVEX. Why would the Black Sea take some of the purchase price? And don't ask me that. I don't cover AVEX. Let's get this out here right there. I told you, Chris Tuttle from IPO Candy covers AVEX. All I do is show you was effectively his risk reward levels, right? Which is he thinks the stock's worth closer to 40 than 20. It's below that level. Look, as it went lower, if you had the guts to trust valuation and risk reward, you just buy more. That's what I did, right? Because on multiple occasions already, when it went public, I told you this is a buy. I didn't tell you to buy because I don't do that. Chris said it's worth closer to 40 than 20, and the stock was at 23. I bought. It went to 40. I sold. It went back closer to 20. I bought. It went back to 40. I sold. It went back to closer to 20. I bought. It went down to 20. I bought more. It went down to 17. I bought more. And now all those shares are in the money or very close to it. I'm in the money overall because my $20 shares are in the money. My $17 shares are in the money. I don't know if I bought $13 shares. Everything's in the money except the shares I bought back at 23, but the stock got to 22. Actually, it got over 23. This is what happens when you actually know what a stock is worth. You don't fear the price because you know what it's worth. If somebody started selling $20 bills for $10, would you buy them? Of course you would, provided that they're real $20 bills. Well, what would happen if next week they're selling them for $8? Would that scare you? And the week after that, they're selling them for $5. Would you stop buying them? Or would you buy more? Of course you would buy more. If they're real $20 bills, why wouldn't you buy more? At 5 than you bought at 10. Think about it. Get it through your heads. You guys are getting in your own way of getting rich. Okay? But this is all I give on AVEX. Okay, we're officially in the lightning round. Sorry for those of you who put the questions in late. Why is basically GCP, AWS, and Azure posting better operating results on their compute investments? Because they're bigger. Economies of scale. And they've been doing it longer. Okay? This is not easy. This is not easy. My investment in Iron is not because I think they are a great neo-scaler. My investment in Iron is based on the fact that their access to energy is worth something. I think they should be acquired. I don't think they should be in business of building data centers because I don't think that they have enough experience and I don't think they have enough scale to do it as well as those other guys, Amazon, Microsoft, etc. Okay? And I think they will sell out because the new management incentives will put $800 million in the pocket of the Roberts brothers if they sell out. So I think they're going to sell out. And this is my, basic risk reward thingy for them, right? I got out here, that worked out well. I got it back in down here, that's working out well. Seeing your TSM chart, what is the purple? Oh, the purple line, the purple square. Good question. There, that's what it is. There's the analogy to the 1999 bubble. Okay, so that square is equal to this square. So you can see we're like getting pretty high relative to what happened in the internet bubble. But make no mistake, TSM is better positioned for this bubble than this bubble. Okay, because this is a build out and it's still going on. And everything I see says NVIDIA's got off the charts demand, AMD's got off the charts demand, and TSM has off the charts demand. I own NVIDIA, I own TSM. I don't own AMD because I think they're the secondary player here, and why own the secondary when I can own the first? Don't you put too much weight on cash and assets? No. Like, there's two parts to the equation. This is your problem, guys, okay? And it's a great question. Look this up. If you're under the age of 30, your brain is probably not fully formed in the aspect of understanding risk and consequence. Okay? It's a true story. Look it up. It's scientifically proven. Your brain is still learning the concept of risk and consequence. And once you learn that, and trust me, don't get me wrong, it took me until 32 to figure it out. Putting a BMW on 2 wheels, driving drunk, things like that, stupid stuff, right? Until I was like, oh, I could die or kill somebody doing these things. It never occurred to me before to that extent because I didn't understand risk and consequence because my brain wasn't fully formed. Okay? Risk and reward. Risk and reward. Both are important. Most of you only care about reward without looking at risk. And so when I find companies that have great upside potential, but the risk is damn near zero, that part of the equation is beautiful. Gucci, a 10. You need to rate both sides of the equation. This side is a 10, this side is a 5. That's a 15. Most of you guys are just not even thinking about this at all and caring about this only. This has the biggest upside I ever saw. It's a 10. Guess what? If the risk is a 10 and the reward is a 1, that's an 11, your 10 is smaller than my 11 because you don't figure out risk. So no, I've been doing this for 30 years. I will say that at this point in time, there are more stocks than usual that are trading near cash and asset value than usual, but I can't help that. These stocks come to me. I don't come to them. I can't determine the composition of my portfolio. It's determined by the rules. Okay? And in my history, it's worked out well to own these kinds of companies, so I will continue to own them. And if it doesn't work out for 1 or 2 or whatever, that's just part of the game. But I've only lost money 3 years since 1996. Arm chart. We'll see if it comes up. Hopefully I didn't lose signal here. Because, let's see. Charts aren't coming up. Hopefully that'll come back. I don't know what's going on there. There we go. No risk reward lines. But look, see, it's pulled back. Remember what I told you? If you guys have your notebooks out, what I say about when a stock gets closer to the 200-day moving average, these great AI stocks, and ARM is a great AI stock. I gave it to you at 100. Go back in the videos at 100, and boom, it went to over 400. I was out by then. I got out around 200. And then it pulled back near the 200-day moving average. I bought, and boom. And now it's running up against the 50-day moving average. Big deal. This company's great. This is a great company. I really think it's a better chance than not that this company will see 400 again. Still need to fight Fugazi. Dude, they won't debate me in public. And there's a reason for that. Do you have a Marvell chart? I don't see, if I don't have risk reward lines, I mean, at least I've got these tentative ones for Marvell. It's similar to what you get with like Air and NVIDIA and all these names. They are very high on the charts because of what's happening, because AI is on 10 and everybody knows it. Okay. But I still own a basket of these names at advantageous levels. In the case of Marvell, I own it because it got close to the 200-day moving average. And maybe I should be selling some of it right now. What is it? The market's almost closing. At the 50-day moving average, I'd take maybe half my profit off the table from having bought it close to the 200-day moving average because now it's at the 50. That's moved up quite a bit. And that just gives me the opportunity to say, let me take some profits. So boom, Marvell, trade. Let me see my position here. Sell. Very easy with Marvell because it's a very liquid stock. And boom. See how easy that is? I don't even have to think about that because I see that the stock is up a lot since I bought it and it's moved up halfway to where it was before and at the 50-day moving average. Okay, I've got a profit. I've got a moving average line. It's halfway to where it was before. I'll take half off the table. How How much weight do you put on the sick AI angle, given that management said that they don't currently see CBD as an AI enabler and that the sick market remains weak? Yeah, absolutely. That is correct, my friend. But if and when that does come back, I've got that in. If you saw my report, you could see that baked into the outer years. Okay, and a DCF is based on all the years' values. Some of you are looking too myopically at near term. It's crazy because you're willing to own SpaceX now that's really doing nothing compared to what Elon wants to do. And Tesla that's really still doing nothing compared to what he was saying it would do 10 years ago. You guys are willing to give him the benefit of the doubt on long-term things, but you're not willing to do that with other companies. That's dumb because DCF is based on all future earnings. How do you feel about Intermap earnings? We talked about that. Supply affected Watt in the deployment. Does that put them in a rough patch? Not necessarily, no. It's a temporary thing, like I said about Radcom. We're already going into overtime, so we're lightning rounding it. Hey, Mark, joined late. Not sure if you covered VTSI's quarter. Yes, I did. Watch the replay. By the way, there is an absolute rock star that just about every week goes into the, not the live comments, but the actual comments. When you pull up this video on the replay, right, in about a day or two, he's going to have all the timestamps of when I talked about everything. So if you want to know about VTSI, he's going to tell you where I talked about VTSI. Dude, salute. You're an absolute GOAT, a rock star for doing that. And that's part of why I do this, because a lot of other people contribute to the team effort, because that's what it is. It's not the Money Mark show. This is the team show. This is the Money Mark experience of what I was taught by my mentor, which he was taught by his mentor. And that actually dates back to people that were involved with Warren Buffett, if you look at it. So in a way, if you think about me as a Wall Street mind, I'm kind of like Warren Buffett's grandson in that regard. I'm having difficulty buying Radcom through Schwab. I told you guys, E-Trade, E-Trade, E-Trade. And if you're not based in the US, yeah, it can be challenging. And you make more money on these stocks because people can't buy them. When some people can't buy something, that gives you the opportunity to make money because they can't. If AI build-out will continue for the foreseeable future and with it memory shortage, why do you see the shortage temporary for Radcom? That's simple because we talked about that already. Because it's not a shortage, it's the price, right? They can get the stuff, but go back to that part of I explained it already. I'm looking for 3 question marks. I talked about Curie already. No, they're not operating on all 10 cylinders. They have up and down quarters. Do you have a chart on D-Box technology yet? Do I? No, I don't. I have not drawn lines on them yet, but I do own the stock. I may have missed it, but who is the competitor to IDN? No, I didn't release that information. Was the drop in IZEA after earnings warranted? Not to that extent by any stretch of the imagination. They wiped out a huge chunk of the enterprise value. That's the thing that you guys you don't realize. What's really funny is that when a company reports bad earnings, it's very typical. Watch, 20%. Look at TSSI, down 20%. I didn't know that that's how it's going to end today, but a lot of times that ends up being the number. Why? Because if the stock's only down 10%, it was a horrible quarter, people are still willing to sell. Okay, I've lost 10%, but I'll take that. I'll take that 10% discount to get out of the stock that just gave us a shitty quarter. But once it becomes a 20% discount, people are less likely to sell because, oh man, it's down 20%. I guess I'll just hold it. It's psychological. But what they don't do is the math on the enterprise value. And if they showed that number instead, what you would have seen on some of these names, some of these stocks, their enterprise value is dropping like 60%, even though the stock's down like 15 or 20. And that wouldn't happen if they showed the enterprise value drop, because people are like, what? They dropped the enterprise value 60%? I'm not selling down 60%. That's crazy. In fact, I think I might buy some. There's a bunch of hell yes. Thank you guys. Appreciate y'all. My understanding is that major players like Wolf and Coherent develop their own furnaces. Yes, there's some of that, but stay tuned, because there's a reason why they're involved with CVV. Why would they be involved with CVV? Why is there a facility that on semi-funded that verified and validated CVV's equipment? Read the report and you'll see that there's breadcrumbs out there. And this is important. These are good questions, by the way. And it is a very critical time for me to explain something to you. The most money that I ever make on stocks is when I'm willing to take a leap of faith based on the evidence I see in the marketplace, not when the meal is sitting in front of me and I know exactly what I'm getting. When I see a hamburger and fries and everything else, you know what I get? High blood pressure. Dead serious. In my life, when people have come to me and laid a story out on a silver platter and said, management said this, that, and the other, this is a no-brainer, boom, here it is. More often than not, that stock goes down. More often than not, the story is BS. The easy money does not work that way. Okay? When you are told why this is easy money, you are usually being fooled by some fraud. And most of you who've been in the market long enough know exactly what I'm talking about. You remember being fooled. You remember being tricked. You remember the sure thing stock that blew up in your face. How? Because they were lying to you. It's the stories where they're not telling you anything, but you're finding clues all over the place that says, why are these guys not telling me anything? Maybe they want to buy more stock. Maybe they're not ready to. Who knows? Maybe. There's no maybes. I'm not going to worry about it. Why? Because I'm not paying anything for the company. I'm getting the cash and I'm paying for the cash and the real estate below market price for the cash and the real estate, and I'm getting the company for free. So if I offer you shares of CVV for free, would you be asking me these same questions? Because that's what's happening. The cash and the real estate's worth $9. You're paying less than $9. You're getting the company for free. And if you can't get that through your heads, just keep watching. Because over time, you've seen these things play out. You've seen these stocks play out. You see my track record. You see my spreadsheet. You see these wins, right? Look, the worst performer in my portfolio was up 20% at its peak. And that means that, and none of these stocks were up 20% when I added them to the spreadsheet. Okay? None of these names went up 20% when I put them in the spreadsheet, which means you could have bought each and every one of these names at whatever price you could get them for after I added to the spreadsheet. And I tell you not to chase, right? I tell you don't chase the stock up 15% because I open my mouth. But you could have done that. And you would have made money on every single one of these stocks. Every single one. Or you'd have the opportunity to, at least. Right? Let's say the stock's up 10% when I add it to the spreadsheet. The worst one was up 20% at its peak. So if you say to yourself, I'm going to buy every single one of Money Mark's names and sell it up 10%, that would work every single time. It's simple math. Do you think if a multi-state U.S. outbreak of blah, 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 blah... No. It's a good question. You're asking about a tailwind for what forcing food companies to track their supply chain better. No, I mean, yes, but no, because the mandates are forcing that. There are mandates forcing that because of things like this outbreak. And that's a great point, actually. The Cyclosporialis, whatever however you pronounce it. Yeah. Yeah. There's your IZEA chart, because we're way over already. Your dark gray line is close to 10 for Intermap. If you zoomed out, what could management do in the next few quarters to reignite the stock other than Indonesian developments? They need Indonesia for that. Period. They need Indonesia for that. Up 60% in the year since I started following Mark. Salute, brother. See? And this is a newbie. This is his first year. His first year following me, he's up 60%. Imagine how much he's going to be up in year 3, in year 5, in year 10, once he really gets the hang of this. Come on, y'all. Yeah, but risk is not necessarily zero if they're burning cash. Look at the cash burn. The cash burn has dropped down. Yes, I understand that. You don't think I understand that? Guido, bro, no offense. I've been doing this for over 30 years. Like what you're telling me is as if I just started doing this. Okay? So don't take what I'm saying the wrong way. I understand that, my friend. That was already understood and baked into the whole analysis. Trust me. That is why the green line is below the current price. Even though the assets are worth $9, the green line is down here. That is a cushion for them to lose lots of money. In fact, they could lose lots of money before it even gets down to this level. And by that time, the activist, the 20% shareholder from Apollo, would have taken more action. You see how that works? I'm trying to teach you something here, my friend. If you're right about that IDN commentary with regards to the alternative vendor not having a working solution, that would be effing ridiculous. You have high confidence in your contacts here. I have high confidence in my contacts here. It doesn't, right? It doesn't make it 100% true, but I put my money where my mouth is. I bought the stock. Is it inferred or factual about the Chinese bidders that are lying about Indonesia? Lying is a strong word, but I think it's facts. Okay? Are we done? We're done. I don't see any more triple question marks. I'm going to go back and read the comments. We went 11 minutes over. I haven't eaten since God knows when at this point. But we got it done. We got it done. The only names that I didn't get into depth about were D-Box and Crescendo. I told you a little bit about them both. I own a lot of Crescendo. I own a good amount of D-Box. We'll get to those hopefully next week because I'm not going to have a million earnings reports next week. What can I tell you, right? It turned out to be a really great week for my portfolio, it seems. I think I just hit a new all-time high. It's nice. Okay, so another new all-time high. So I'm definitely up more than 100% year to date from what I see here. And it's just by following the rules. By having the balls to do with a lot of people, and still a lot of you aren't willing to do. You're still questioning certain things that you've been taught or been told by people who aren't truly experienced in being successful. Find people who have earned 40% a year. I'm not saying that I should be the only person you talk to, but go find people that can give you a proven track record. This spreadsheet goes back, okay, to 2014 when I gave you Facebook at 57. And I don't know if that's split adjusted. Let me see. That was in May of 2014 was my first entry into this spreadsheet was Facebook, May of 2014. There is May of 2014. Facebook down. You can see even, look at that. Look at that, this thing of beauty. May of 2014, the stock was on its ass, right? It had just dropped heavily, okay? 20% drawdown, and that was the moment. And look, see the moving average line, everything. This was a 50-week moving average. It pulled back 20% to the 50-week moving average, and I said, go. This is how I'm starting this spreadsheet. And the stock has done nothing but go up to 600 from that time. From 50, so this is no split since there, 57 to 600. That was my first entry. And it went on and on and on. And before this, right, 2014, I spent 5 years giving picks on Seeking Alpha. From January of 2009, my first pick was Lionsbridge at $1. And people were like, this piece of S company, what are you talking about, $1 stock? It got acquired for $7 by a large, well-respected company. This is what happens when you really understand companies. Okay? The things that you've been taught by CNBC, by books, by a professor,
at a university? Are you kidding me? Unless that professor at that university's name is like Warren Buffett or has a track record of earning 20, at least 20, preferably 30 or 40% a year. Mine owned a Honda Accord. Mine was probably paying rent month to month. Okay? Not getting paid enough. Teaching finance, but not actually understanding finance. Okay? That was my first stock course in college. It was BS. I should get my money back. CNBC is all BS. They're trying to get your eyeballs. Most of the people, 90% of the guests on CNBC do not have the credentials of somebody that I think you should be paying attention to. You have to find those people. Okay? I think I'm one of them. That's up to you. But you need to hold people to this standard. And with that, the week comes to an end. So join me next week when it's Friday. It's Money Mark. It's Stock Talk Live. Have a great one, guys. Take care. Mamma mia. What we got here? What the heck happened to my portfolio today? Got some winners, chicken dinners. My hedges were up too. No, not all of them. NASDAQ down. See? I mean, look at that. Like, the Russell was up. The S&P was up ever so slightly. Well, the equal weight S&P was. The actual S&P was down. But the worst performer was, looks like, the NASDAQ. The Qs, rather. Qs were down. Because maybe valuation. Money's rotating into other names that are better values, better risk-reward profiles. No. What else? We'll look at this later. I got to get to sleep. I got to get some food.